This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone, especially those not intended to listen. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is June 11th. Andy Lebow.
Hey Jim, how are you doing?
I'm doing good, thanks. And let's pick up from our last podcast back in May, where we came out of that thinking we were going to move, the market price was going to move sideways to higher, and we were wrong.
We were wrong. That was a horrendous call. The one thing, I don't know if you could take solace from the fact that we were not the only ones that were wrong.
It doesn't work for me.
Doesn't work for you. No. Yeah, me neither. But
yeah.
Sometimes it's like, all right,
yeah,
I'm not the only guy that messed this up.
I think I would rather be wrong alone, and right, than wrong in a crowd, something like that. Anyway, what happened? What did we miss?
What didn't happen?
Yes.
What didn't happen? I think what we missed. Well, first of all, during the month, the trade negotiations with China pretty much fell apart. So I think that was certainly a bearish factor. And then Trump decided he was going to slap a 5% tariff on Mexico, which also got the markets pretty unhinged, or got the equity markets unhinged, and didn't help the petroleum markets. But I think that what we saw in our market in particular was the fact that inventories built by way more than what we had anticipated, and really what the market had anticipated, Jim. If you had looked at the balances, it looked as though second quarter inventories were going to draw by hundreds of thousands of barrels a day, and the reality was that they've been building, and at least in the U.S., which we're going to talk about in detail coming up. So I think that was certainly one bearish factor, and no doubt concerns over the world growth vis-a-vis the trade, the world slowdown, and the markets trying to figure out what's that going to mean for demand growth going forward. And actually, demand in May was pretty crummy. Finally, the position, the bet was long, and the commitment of traders showed in March and April that longs to short were double digits in both Brent and in WTI, and that position was liquidated on a fairly grand scale. So you had long liquidation thrown in, and I think that's just some of those things. Jim, you may have another one or two.
Yeah, no, I was thinking when you say long to shorts, you're talking about the ratio of long position, speculative length versus speculative short positions.
Right.
Yep, and that got stretched a little, is what you're saying.
Yeah, it got stretched a lot. In a pretty short period of time. At one point in April, WTI was 14-1. Brent was 16-1. So that's longs to short, which is definitely on the long side. Right now, WTI is 4-1 and Brent is 7-1. So as I said, major liquidation thrown in here.
Now the correlation with the S&P with crude oil based off the CME's correlation tool, if you go like 1 month time period, it's plus 0.52. 6 months, it's about the same. You go out a year, it's only plus 0.37. So, we've been when the stock market moves, the oil market's going with it, and I guess the connection there is global growth, right? I mean,
right.
it's
Yeah.
so the let's talk about these stock levels for just a second here. The big three organizations that come out with supply demand estimates on a monthly basis that we talk about is the EIA, the IEA, and OPEC. And the EIA came out today, and they still show a draw in the second quarter inventories of 200,000 barrels, despite this weakening demand. So, is that a number you're with, or you
Yeah,
get?
I was with. I definitely was with. I thought the draw in the second quarter would be something like 200 to 400,000. So, I definitely was with that. But in April and in May, U.S. total inventories built by 1 million barrels a day. So, we probably should draw in June to get that 1 million barrels a day number down to maybe 500 to 600. But for us to have a global stock draw, clearly it's got to draw elsewhere in the globe. And I'm not sure that. Well, that could be happening because while the Western Hemisphere we've moved into a carry market, into a contango. The East, the Brent market still is pretty tight. That's still backwardated. So, that would indicate that stocks have drawn. But we're going to have to see some kind of U.S. stock draw, Jim, to get
Yeah,
that down, to get that to draw 200.
well, is some of that U.S. I mean, some of the U.S. build is due to the weather. I mean, the pipelines getting out of Cushing were I guess some of the pipelines going to the refineries were down, and some of them basically moving out of Cushing were down, so that caused some of the build.
Right. I think
but not all of it.
No, not even close to all of it. The big reason for the crude makes up for a fairly significant share of the total stock build. And one of the reasons why crude has built so much during April and May is that the demand for crude, as evidenced in crude runs, what we actually run through a refinery, has really been soft because these refiners have had all kinds of trouble getting their refineries to operate at anywhere near peak capacity. Part of that is weather. There've been floods. The Midwest has been inundated. There have been floods in Louisiana. So as a result, and refiners are taking some prolonged turnarounds to get ready for the IMO. But we're running a good 500,000 barrels a day below where we should. So there's half of it right there in the crude build, Jim.
Right.
Is what's happened on the refinery side.
Another piece of this weakness could it be that people were buying ahead of the sanctions or the expiry of the waivers, and so they bought a bunch before that, and then now they don't need so much.
I think that's also a factor on crude demand. China had a massive import number in April, and lo and behold, their May numbers were down.
Right.
Total crude imports, and that's not a big surprise. We'll see where June and July comes in, but I suspect that we've definitely that we've seen some of that on a global basis, and therein lies demand for crude. But the thing that is really kind of worrying is that despite the fact that U.S. crude runs have running well below where they should be or what the market had forecast them to be. Refinery margins, particularly in the Gulf Coast, are horrendous. Now, whether that's demand related or related to flow, product flow because of what's going on on the rivers in the Midwest, or that's hard to say. But the margins are weak here and they're weak in Asia, and that is on the end user side, Jim.
Right.
I mean,
Yes.
that's like where, all right, maybe demand really is soft.
Yeah, because we were thinking global. There weren't too many signs of global demand weakening too much, and if you look at again going to the EIA's release earlier today, they shaved a couple 100,000 barrels off of looks like off of 2019 demand.
Right. Yeah.
So they're at 1.2 now.
Right.
That's so they shaved 200,000 from the last forecast. They also shaved supply as well, but the global demand is looks like it's not as strong as they thought.
Right, and these May numbers in the U.S. came in real soft. At least the unrevised numbers came in soft, and diesel distillates really came in soft, and that also it's hard to say because the planting owing to these floods is running way behind normal. In the Midwest, and as we know, you need diesel for the farm equipment. So there's the weather may or may not have played havoc with some of these numbers, or it could be a response to an economic slowdown. We don't know yet.
We need more numbers.
We need more numbers. We need more. We need more data. But
it's interesting because on the move down, I was watching the options market, and I put this on our blog but the flow, everything that you would expect to happen in the options market on these big moves down, volume was up, more puts than calls traded, volatility blew out. All that stuff you'd expect happened, and yet you saw more open interest show up, increase in the call side than the put side. So I was kind of thinking, well, if you were a barrel counter, if you had listened to our podcast, that's kind of what you would be doing. You would be putting on, and you don't know for sure whether they're bullish or bearish positions, but typically when open interest and calls on a decline happen, it's somebody buying them, not selling them. So I was reading that as somebody buying or the market as a whole buying dips in a way, and then the market went up for a couple of days after that, and it made bigger new lows.
Right.
But the same pattern, the same option pattern as people were. So basically, you have to say maybe it was adding more fodder for the bears to destroy, I guess.
Yeah, that could definitely be, Jim.
Yeah.
It sounds like we've seen that before. That's
right. So,
that's for sure.
It was a little like a counter. So maybe it's happening now. We'll see. But still, the market did collapse. Also, since I brought up options, I had talked about earlier in the year how the volume was kind of low, and it picked up last month, 153,000 a day, but still that was down like 14% from last year, and the year to date's running around 122, 32% down from last year, and I just have to think that there's a lot of speculative activity that's gone. It's just maybe they just haven't been able to make money in this noisy market. I mean, you have the usual noise of oil, and then you have our president who's sending tweets out that move the market. So it's really so I don't know, but it just seems like there's less option activity out there these days. Still,
I think that's true, Jim. And I talked to a number of traders this week and last week. Talking about tweet risk. And, I never thought ever that I'd have a serious discussion, with a oil trader about tweet risk. but we did. And his conclusion was, they're really shaving their positions because they've done the fundamental analysis, and something like the Mexican tariffs comes out, or
Right.
something about China.
Right.
I think this move seems more than just tweet risk, but Trump has become a big factor in our markets.
Yeah, I have to say, I also, I talk about it's an oh my god world, but I wrote one of my pet peeves, and I'm sure I talked about this on previous podcasts. When for some reason when the market goes down by 20%, the financial press media has to say, we've entered into a bear market. I don't know where that came from. The 20. I mean, if I buy oil today, it goes down tomorrow. I feel like we're in a bear market, right?
Right.
And then think about when we were 2014, when we went from 100 down to 60, or even eventually got down into the below $30. Can you imagine telling a producer reading this in one of the leading financial papers? We go from the low and we go up 20%. And now we're in a bull market, but we've only gone up by maybe $6. I mean,
right.
It's nonsense. I don't know why you find that kind of talk, but that's just me. I have a lot of pet peeves.
Yeah, that 20% has become almost institutionalized.
I know and it's almost when they tell you you're entering a bear market, I'm guessing it's probably more likely than not a time to be buying it, not to be thinking of, oh, we're in a bear market, we should be selling.
Right.
It's just so misleading. That's all I'm saying.
You know what I think is, talking about the producers, hopefully they had a nice window where the calendar 2020 was over $60 or very close to $60. And, hopefully they took advantage of it by sell hedging. I mean, there's, I think they did. I think that, the open interest has been pretty robust, and like the D's 20 and the D's 21 futures. There's been a lot of negative press this last week or two on the E&P companies, but one thing to their benefit was that the market was there to put on some sell hedges for the balance of 2019, 2020. 2021 didn't quite get up to 60 on the when the front was 66.60, but it was up to like 58, 59, close.
Right. Yeah. We probably don't have time to talk about this, but it's another issue is, do you hedge your business by, buying puts, selling futures, or do you do it by strengthening your balance sheet? So, I'm just hearing or seeing more people talk about how, especially in the fracking world, there's much more discipline now to think about cash flow and not so much just drill, borrow, drill. So I'm wondering if, there's more of a focus on, cleaning up the balance sheet as opposed to doing lots of hedging. So I don't know. I don't know if they caught it or not, but
yeah. Well, I think there should be focus on both.
Yeah, it's probably yes. I mean, it's the more that your revenues are based on the price of oil, the more you need to hedge, right? We've seen that. I mean, if you're an integrated oil company, maybe you don't need so much if you're a pure producer. You probably need to be thinking about it for sure.
Every day.
Every day. But then my comments are. I was thinking about that. I think the EIA put something out that I put on the blog about where the revenues were coming from, and it just wasn't a lot coming from hedging over the past few years in up markets and down markets. Obviously, more would come from the down markets, but it was still a small percent of the total. But we probably should get a hedger on here in a future podcast.
Oh, I think we will. I mean, we had Andy Furman on, which was a great podcast
Yeah,
last year.
because he talks to these folks all the time, and
Right.
that's his business.
Yeah.
Yeah,
And maybe we'll re-release that one, Jim,
yeah,
because it it's still very relevant
yeah. Oh
today
yeah,
because the market comes off. Obviously it's easy to look back in hindsight, but when you've got a hedging program, you need discipline and you need foresight. You know,
yes,
and you need to know what price is going to work for you and do it.
right.
When it hits your target. I suspect that they may get another chance.
Yeah,
Uh,
yeah.
to,
I was going to ask you. Some people are talking about how yes, the market's a sloppy now, but very soon we're going to tighten up again and we'll be off to the races.
it should. As I mentioned, the Brent market is still pretty tight. Part of that is the Russian problem on the contaminated crude. So there's been alternative demand for North Sea crudes and other lighter type crudes. And part of that is there is some maintenance in the North Sea, and we don't know if their stock draws or not, because that data is not available yet. But I think our market is I think the U.S. market could tighten up as soon as these runs. We need to get these runs going,
Right.
and they should, as we head into June and into July. We should start seeing our runs get from under 17 million barrels a day up to like 17 and a half. 17. The EIA has them up to 17.8, I think, in either July or August. So demand for crude is about to really explode through crude runs. But again, we'll see what happens. We're also going to need to see petroleum product demand, still carrying it, because these margins have to improve.
I was going to ask you, can you kind of see that in the crude curve that runs are going to start picking up?
No.
No,
not really. Not
no.
really. I think. Well, what's happened in the crude curve is, I guess so, Jim. I mean, the backwardation was pretty severe, and that's softened because of the infrastructure problems. So it's hard to, it's now contango. So it's sort of hard to see,
Right.
in the curve. But you can definitely see the curve flattening out or getting less backwardated. It's definitely a function of these stocks growing way more than what the market had anticipated. So one would think that as the runs increase and stocks draw, that the curve should tighten up. Now there was a big trade, right, Jim, on in the CSOs.
Well, there's which
August SEP.
yeah,
Is that it, or SEPOC? I mean, there's some.
Yeah, I don't have the specific trade in front of me, but I have the top 20 open interest, and if you look at on the put side, it seems to be the minus 25 put going out. Maybe the big open interest is the OC Novi Dees 15,000. If you're talking about August, the minus 25 put has 11,000 open, and the flat put has 8,000. So I'm not sure which one of those was the one you're talking about. And then on the call side, the SEP OC plus 25 calls got 26,000.
That's the one.
25,000.
Yeah, that's the one.
And that's like 8,000 more lots of open interest more than anything. And there's a little bit of volume yesterday. It looked like some liquidation, but so the SEP OC plus 25, and then this, if you use a strip OC Novi Dees, the plus 25 is the most, it's got the most open interest. So those have been pretty busy, active over the last month or so. But so that's I guess that was my question is, are we moving? So there's a delay in having these refiners come back to full capacity. Does that push everything out a couple of months, are we going to see? We're going to see them go back into turnarounds at their usual time, or are they going to push that out more because of
Well, I don't think they're going to push it out. You have this IMO coming up. They want, and a lot of this delay is getting ready for the the new specs on the shipping for shipping. So I think in October, November they'll be taking their turnarounds.
They will be.
They will be, but it'd probably be shallower than what they've taken this spring.
And at the same time, they're not going to because they haven't come back so quickly now. So you think it's scheduled maintenance will be at the usual times?
Yeah, I think it'll be the usual times. They're coming back at a poor margin environment. So, but again, it's unclear, exactly why these margins are as poor as they are, unless demand really, if demand is really horrendous, then yeah.
Right.
But there are all kinds of infrastructure problems. So it's really the Gulf Coast that demand. The margins are okay up here in the Northeast. Though at the Gulf Coast, they're pathetic. So it'll be interesting to see how everything clears out over the next few weeks. And we also, let's not forget, we have an OPEC meeting coming up either this month or the early July. So the market will start, turning its lonely eyes to OPEC.
It's scheduled for the 25th or the 26th, right?
Right. They were talking about maybe moving it back to the first week in July. I think it's still scheduled for the 25th and 26th.
So the Saudis were about, I think, 500,000 barrels under their commitment.
Right.
And now, are they? Do you have them as what?
Well, the last numbers for May were more like their commitments like 10.3, I think it is, and the May numbers were a little closer to 10.
Okay.
So that they've said if the market needs those extra 300, that they provide it, but obviously clearly given where the price is, that they're not going to. I don't see them increasing to 10.3. They may even dial it back some. They were very happy, at the 70 to 75. I think they'd be okay. Brent 65 to 70, but down Brent near 60, nah. I mean, they need some higher prices, for all their fiscal commitments. So
what are the issues going into this meeting?
The issues are good. Yeah, I mean, the main issue is whether or not they're going to renew their production deal, which expires on June 30th. And given the fact that no matter what they say about inventories and supply demand and everything else going forward, they're pretty price responsive. And, at the end of the day,
Right.
it's going to be, what the Brent price is and what the formulas are,
yes.
Right? It's number one on the hit parade.
Andy, you remember when the OPEC ministers didn't believe futures prices?
Yes.
Yeah. And you remember one minister said to the press, "Don't believe those numbers you see on your screens." Do you remember that?
Yeah, right.
That's where we realized that these guys are watching the price very closely.
Very closely.
Yeah.
And, so having said all that, yeah, I mean, with Brent, closer to 60 than 70, I don't see any particular rush to increase to end the deal. And I think the Russians are now on board, that they need higher prices as well, particularly after this catastrophe with the Friendship Pipeline. So, it looks as though, the deal is going to be extended, maybe through the end of probably through the end of the year. And, there may be some pressure on, Iraq is probably Iraq's taken a lot of the Iranian market share. We'll see what they if they pressure Iraq at all. But OPEC production's around 30 million barrels a day. I think it could go a little bit lower, but not too much. I think it's going to be 30 plus or minus a couple of 100,000 barrels a day, at least through the third quarter and maybe into the fourth quarter.
And what do you have as the call?
Well, the call, assuming that demand is down 200 to 300 barrels a day, the third quarter looks like it's about 30.5, 30.6, maybe, and fourth quarter looks like it's about 29.8, 29.9. So, third looks like we're going to draw. Fourth looks balanced. And then first and second, you're depending on how much U.S. production increases in the first half. We're looking at stock builds, particularly the second quarter, according to the EIA, looks ugly. Big stock build.
Mm.
So,
Is that what you're looking at too?
For second quarter? Well, we haven't gotten, second quarter 2020 looks like it. I'm talking about second quarter 2020.
Right, that's right.
And we're later this week, we'll see what the IEA, they'll have their first look at 2020. And I think OPEC does as well. I'm not sure, whether OPEC gives you a 2020 look, but the IEA definitely is giving you a 2020 look in couple of days. I think that, it's certainly possible that we get somewhere near a 500,000 barrel a day stock build in the second quarter.
Wow,
but we have a long way to get. We have a long way to go.
Right,
let's
figure out tomorrow.
Right, we were pretty certain that we'd see fourth quarter 2018. The whole world was buying $100 calls.
Right, that's right.
Because we were going to draw inventory like there was no tomorrow.
Yes.
And, that certainly didn't happen.
Came crashing down. Just a couple of things. We mentioned the big three, the EIA, that's the arm of the U.S. DOE, that came out today, earlier this afternoon. The OPEC's report, the monthly report, comes out on Thursday, the IEA on Friday. Now, the OPEC report and the IEA report get well reported in the financial news. Nobody seems to care about the EIA, and it's a good report, right?
They're
all good, but it's But
I'm not sure why, because the IEA is the gold standard,
Yeah, right.
And then OPEC, and then all the bank reports. So the EIA, the short-term energy outlook, maybe it's because, the EIA puts out so much information. The short-term energy outlook, which came out today, does get a lot of press on what they think about the U.S.
Oh, right.
Production, demand. The global stuff, I think they lead, doesn't carry as much weight as what the IEA is saying and OPEC.
So I mentioned the EIA, which came out today, the second quarter. They have a draw of 200,000 barrels a day for the second quarter. This is worldwide. And for the third quarter, they have a draw of 600,000.
Right. Yeah.
And then within there was a Reuters story that kind of summarized what people are looking at in 2020, the surplus, and they had anywhere from 100,000 barrels up to 800,000 barrels of surplus for 2020. So, I'm thinking about this. Well, do you trade this, decline? I mean, if it's a draw, do you trade that, or do you trade the build that's coming? How do you play that? I mean, that's the game, right?
That's the game.
Yeah.
That's definitely the game. That's the game. So,
So what do you think is going to happen going forward?
What I think is going to happen, I mean, clearly the market has moved into a lower range than what we thought.
Right.
Frankly, I thought we'd see new highs in May or June, and it clearly didn't happen. I think there's still a lot of, as we just spoke about, despite the fact that, demand may be may be softer. We know that crude demand is going to increase because these runs are going to go up, and there's going to be and in both U.S. and in Asia where there's some new refinery capacity coming up. So I do think we are going to see these draws. I think that OPEC is going to renew their price deal, and I think the market is going to settle into a range. It's it's unlikely to get up to 60. I shouldn't. Well, right now it's hard to say it's going to exceed WTI 60/60, which was the old high. But could it get into some kind of 50 to 60 range, or 52 to 58? Something like that. I think we'll start seeing the market.
Your bias is that we're at the lower end of a range.
Yeah. My bias definitely were. Yeah.
Like you wouldn't expect to see a four handle in this market.
Well, I think it's possible, Jim.
No, I know.
Right?
No.
I mean,
yep.
No, I wouldn't. I really wouldn't expect to see it unless we, if these refineries never come back, and runs stay really low and demand continues to soften. It's certainly possible, if we're in more than an economic slowdown.
Right.
It's certainly, it's certainly possible.
Right. Yes.
But third quarter looks pretty good. Third quarter looks okay. Third quarter looks constructive.
Yeah, that's probably what's behind all that call trading, right? In the plus 25 SEPAC.
Yeah.
Somebody thinks somebody is putting money down, thinking that the refineries come back, situation's much tighter, and we go into we go backwardated above 25 cents.
Right. Now, where that could fall apart is refineries come back, margins continue to, demand continues to weaken, and all of a sudden their economic run cuts. So that's something to watch.
So again, we're coming out of this podcast similar to where we were in the May podcast, with looking for things to tighten up, just as
but not quite as explosive as as May.
Terrific.
Because of this stock build.
Right.
Now we're working on a much higher inventory number than we had imagined. We're in the 480s on crude. Yeah, I didn't have 480. I had maybe 470 something as an outside peak.
Mm. Okay. What did we miss? Anything we need to add before we sign off this month, Andy?
I think we have everything. And we went through a lot of stuff. That's for sure. We even threw in some, our hedging conversation.
Yeah, I think there's so much stuff going on, as always, in these oil markets. It's hard to cover everything, but you start hitting. I think we hit the bulk of it.
Yeah, but as usual, you can find us on the web at www.commodityresearchgroup.com, and you can reach me at alebow@commodityresearchgroup.com.
Okay, thank you very much, Andy. We'll do this again next month.
Yes, we will. Thanks, Jim.